This is your Monex Metals Market Update with Mike Maroney.
Good afternoon. It's Thursday, January 24th, and it's Mike Maroney coming to you from the Monex Deposit Company Precious Metals Studio. We're here today with Philip Klapwijk, the head of Precious Metals Analytics at Thomsom Reuters GFMS. Philip has been the top-rated precious metals analyst 2 out of the last 5 years, according to the London Bullion Market Association. And he's a very good friend of us here at Monex Deposit Company. We had an opportunity today to sit and listen to a presentation by Philip as far as his 2013 projections were concerned. And what we'd like to do today is share some of those tidbits of information with you, the precious metals investor. I think it's important to understand that Monex Deposit Company is not a coin dealer. We're not a bullion sales force. We are a precious metals specialist. And it's our job to give you the best information possible so you can be better equipped to use precious metals in your portfolios. First of all, Philip, fantastic seeing you today. Thanks for coming by. Last year, you did a phenomenal job in January of 2012. You made some tremendous projections, and it pretty much played out almost exactly like you spoke about. And here we are entering into 2013. First of all, I'd like to ask you a little bit about your supply and demand numbers for gold. It's very interesting, with the price of gold having continuously moved up for the last 12 years, the supply of gold has only jumped up an additional 6% this year. Do you see any major supply increases on the horizon, or is easy gold a thing of the past?
We are thinking that there could be some incremental growth in supply this year. We're looking in 2013 for global mine production to rise by some 35 metric tons. That's about 1.4%. We also think we could see perhaps a little bit more recycling of jewellery, but overall supply should be up very modestly, taking into account the level of gold prices.
Now, the one thing that really stood out to me was the major change that seems to be taking place as far as the central banks is concerned. Now, a lot of people are talking about the fact that we're in the midst of a currency war, as Japan and many other countries are trying to lower the value of their currency to become more competitive in today's world economy. What's happening as far as central bank demand is concerned?
Well, central bank demand over the last few years has moved radically. It's moved from net selling on a global basis, net selling of some 500, 600 metric tons per annum, to precisely the opposite. We now see central banks collectively buying over 500 tons per annum. So that's a swing of the best part of 1,000 tons, 30 million ounces, that's taken place over the last few years. And it's being driven by the same sort of factors which are affecting private sector investment demand for gold. Namely, central banks are looking for a hedge, they're looking for a safe haven, and above all, they're looking for portfolio diversification against major currencies.
So the world's bankers, the gentlemen that basically make the decisions as far as printing paper money is concerned, they're buying gold.
Well, emerging market central banks are. They're looking at what's happening in the developed world. They're watching what's going on in the United States, in Europe, and now Japan. And their conclusion is that currencies are not a safe bet in the future, that they're overinvested, overexposed to assets like the United States dollar, and they're looking to gold to provide some balance to their portfolio, some form of diversification against what they perceive to be greater currency risk due to these monetary policy experiments that we're seeing in the developed world.
Now, a lot of people talk about the Western central banks as being somewhat stagnant as far as purchases are concerned. And we're seeing countries like Russia, Brazil, China, and other central banks. It seems as if the gold is being taken out of Western hands and moving more into Eastern hands. Is that something that you see as a trend for the future?
Well, I think if you look at the balancing point, as it were, of the market, where the centre of gravity of the gold market is, that's clearly shifted east. And it's shifted east both in terms of official sector activity. Western central banks today are basically doing nothing. They're neither selling nor buying. They're not even lending much gold anymore. But where the buying's taking place in terms of official sector or central bank activity is clearly in the emerging markets, and that tends to be Asia and some other countries such as some of the former Soviet Union. Brazil is another one you mentioned. It's the same with the private sector. If we look at demand in the private sector, the centre of gravity for that demand has also shifted more to the east than formerly was the case.
Could it be that the Western central banks are too busy printing money so they don't have time to actually go out and buy gold?
Well, I think what's happening with Western central banks is that firstly, they do not have this huge build-up in foreign exchange reserves. They're not running the same sort of current account surpluses that we're seeing in many of these emerging markets. They're not faced, therefore, with the same embarrassing problem, if you like, of what to do with their foreign exchange reserves. The emerging market central banks can also, I think, take a more honest and neutral view of what's going on and are, in many cases, concluding that they're not happy with the situation, they're not happy with competitive devaluations, with potentially inflationary policies, in the long run at least, and they're saying, well, look, we'd rather have a bit more gold in our portfolios.
Based on the fact that the US dollar since 2002 has dropped approximately 35%, and the value of gold has actually gone up each and every year for the last 11 plus years, it would make sense for all central banks to diversify out of their dollars and buy more gold. Do you think that we're going to see more and more of this in the future?
I think we will see increasing amount of buying from emerging market central banks. I don't think this is just a flash in the pan that is a result of the global financial crisis or the difficult conditions we've had since the collapse of Lehman Brothers over the last few years. I think this is a sort of at least a medium-term trend which will be driven by emerging market central banks who are foreign exchange rich and gold poor. If you look at the Western central banks, on the other hand, many of these still have very significant legacy positions in gold, but they're basically not touching them. They're sitting still. In the case of Europe, for example, I think the crisis in Europe has meant that central banks don't want to start selling gold and spooking the markets. They'll lose far more than they could potentially gain from raising cash through gold sales. So they now are sitting tight. Formerly they were selling. So the action really is being driven by these emerging market central banks, which collectively, probably this year, are going to purchase something at least in the order of 500 metric tons.
Now, when you talk about legacy positions, obviously the US, Germany, Italy, some of these countries have been holding on to gold, since the Bretton Woods Agreement. But we don't know exactly how much gold China has. But we've been told that their overall gold reserves are less than 2 to 3% of their foreign reserves. Do you think that number is fair, or do you think maybe that's going to shift?
I think that number is probably a conservative one, because that number is based upon what China reports to the IMF as its monetary gold reserves. Our information is that China probably has other non-monetary gold reserves, which it doesn't report to the IMF, for example, and those reserves probably have increased in size over recent years.
Now, a lot of people say that China has approximately $2 to $2.3 trillion worth of U.S. debt, and obviously if they just stop buying U.S. paper, a lot of people believe that the dollar could fall into the proverbial abyss. But if we saw some sort of major shift where they would look to maybe have a 5 to 10% position in gold, the price of gold could skyrocket in that type of scenario. Am I right?
Well, I think the Chinese, this is one reason why the Chinese are playing their cards pretty close to their chest, is because they don't want to do something that pushes the price up against them. I think the Chinese are in here for the medium to long term. I think they're looking probably to build reserves over a multi-year period, and therefore they'd rather the market remains relatively calm and that prices aren't moved against them.
I guess there's a joke. They say that an American long-term trade is about a week out, but a Chinese long-term trade is about a century out. So what you're saying in essence is the Chinese are planning for the long-term future, don't want to push the price of gold up too fast so that they can continue to accumulate at good price levels.
I think that's precisely it. I think what they're looking to do here is move out of an embarrassingly large and difficult to get out of position in US dollars, or at least diversify out of US dollars. I'm not suggesting that they're just going to dump US treasuries, but they're looking to, over time, move out of this big position that they've got in the US dollar and at least build up a sizable stack of gold, which will provide them with the diversification that they seek. And that, given the size of the gold market and also the size of the US dollar position they have, has to be a multi-year project.
That makes sense. Now, it's very interesting when you hear the tidbits of information that comes out of the different central banks, but recently there was some news coming out of Germany that Germany plans to repatriate 100% of the gold that they have in France and 20% of the gold that they have in the New York Fed. Is that some sort of signal? How do you read that as far as a piece of information that actually means something else?
Well, I think there are various reasons why this is taking place. Perhaps the most important is the pressure that's been put on the Bundesbank by citizens in Germany who wanted a proper audit of the Bundesbank's gold reserves. And in response to this, the Bundesbank is repatriating a good part of its gold stock, even if that's perhaps not something they want to admit in public. But clearly, there's been a reaction to public opinion on this one, and they're going to move some gold back to Germany. I think what this also tells you is that the Bundesbank's view of gold has probably shifted over recent years. A view that shifted from considering, at least, strategic gold sales to ruling them out and now saying we'd actually prefer to have a decent portion of that gold closer to home.
Well, when the world central banks are bullish on gold based on the fact that they're the ones that get to print money, it would probably be safe to say that long-term gold is still in a pretty strong bull market.
I think what some of these central banks are also looking at is gold as an insurance policy. They're prepared to believe that the world may continue to roll on a more or less even keel, that there'll be soft landings or what have you. But they're also, I think, cognizant of the danger of a hard landing, of a situation which will be far worse than the consensus outcome. For example, what if you see massive devaluation of the US dollar? What if you see major inflation in the United States? And I think they see that that is a very real possibility which they need to guard against. They need an insurance policy against that. And so therefore, diversifying into gold provides them with some degree of comfort against that situation were it to develop, even if they put a relatively low probability against that situation developing.
So the central banks, in essence, are buying for insurance or protection. Here at Monex, we talk to the individual investor on a regular basis about looking at precious metals for profit and protection. But when the central banks of the world are using gold as protection, it would make sense that the individual investor look at having at least a portion of their portfolio in gold. What percentage do you think is a realistic number that somebody should shoot for?
Well, I think it really depends upon your risk profile. Is the purchase of gold primarily driven for portfolio diversification purposes, or is there a speculative element? Or maybe some investors prefer to concentrate that speculative element on purchases of silver. I think to look at what trends have been in the past is perhaps a reasonable guide. And you know, the typical advice from the private bankers of law in Switzerland, in Geneva and other parts of the private banking world was 5 or 10% of your portfolio should be in gold. That sort of traditional yardstick seems to me to still have a lot of sense.
That makes sense. Now, if you think about what's happening in the world today, a lot of people have talked about the perfect storm. And I know you utilized that term recently in one of your reports. And when we think about the perfect storm, we think about numerous catalysts converging simultaneously to create some sort of event. What major catalysts do you see in the marketplace right now that could potentially drive the price of gold much higher?
Well, I think there are two that I would put my finger on particularly. One is more pertinent perhaps to 2013 and the other is more of a sort of medium-term risk. This year, I think one of the big stories which is still brewing is that the United States is going to suffer a further credit downgrade, and that Moody's and Fitch will join Standard & Poor's and strip the United States of its AAA status. And I think that is a risk which is underplayed and not fully understood, because it will represent a massive change to the bond markets and will, with one fell swoop, remove the largest AAA market in the world from investors. What will investors do in response to that? At the margin, I think some of them will look at gold as a serious alternative. I'm not suggesting that we're going to see huge amounts of dollars flow out of the US Treasury market into gold, but at the margin, this could provide a very powerful support for further investment in the gold space.
So there's approximately $11 trillion worth of US debt being held out there. And suddenly in one fell swoop, if they lower our rating from AAA, even if a small percentage, even 1% of that money were to move into gold, what could happen to the price?
Well, if you had 1% of 11 trillion moving into gold in a hurry, that would have a pretty major effect. In fact, that 110 billion would be would actually be more or less equivalent to all gold investment on a net basis that's projected this year.
Wow.
So that would make a massive impact in terms of the price of gold. I frankly don't think that you will see such a large outflow. You know, we've always heard these weight of money arguments, and they never seem to quite come out in the way that, you know, the optimists think they will. But in an underlying sense, I think this is long-term very good news for gold if it happens, and I think it will happen. The other thing that I think we need to keep our eyes on is what if the US starts to come out of recession. Well, it has come out of recession, but economic growth picks up perhaps in the second half of this year, moving into 2014, and we start to see money come out of the Fed and into the real economy. Banks have basically taken a lot of this money creation and put it straight back on short-term deposit at the Fed. If that money comes back as credit growth in the real economy and the money multiplier picks up, we could well see a major expansion in money supply and inflation start to become a bother for more investors.
Now, the amazing thing when you think about inflation, over the last 10 plus years, we've seen positive returns in gold each and every year. Most people say that the ultimate catalyst as far as gold is inflation. And really, we haven't seen inflation rear its ugly head yet. So that catalyst is still sitting out on the horizon and could be a tremendous boon as far as the price of gold is concerned.
Yes, I think it could be. In a sense, inflation's playing a part at the moment. It's playing a part because we're in a negative real interest rate environment in Europe and in the US. Inflation's low, but interest rates are even lower. What if inflation picks up? Well, we will probably see the Fed, here at least, behind the curve, very slow to tighten, not wanting to drive the economy back down again, not wanting to push up unemployment again. And we could therefore see negative real interest rates widen out. So from negative 2% at the moment, what if we see negative 5% in terms of real interest rates? That, I think, will provide a very powerful stimulus to gold, because I think it will bring in a lot of new investors into the market.
Many analysts believe that if you look at the gold market, the first thing you need to do is look at that negative real interest rate. And once you see that, you know that it has an underpinning to potentially push the price of gold higher. Now, you had a tremendous chart today, and it talked a little bit about how the unemployment rate in 2009 peaked in November at 10%. And the Fed has already made an edict that in order for them to potentially start to raise rates, they would need to see a 6.5% unemployment rate. And you had a tremendous number which gave us an idea as far as when we would potentially see that if we continue to see job growth similar to what we've seen over the last few years. And I think it came out to where we wouldn't see that number until mid-2015. Is that correct?
Well, if you extrapolate the improvement, as it were, in unemployment, the reduction in unemployment on a monthly basis, and you take that average and you extrapolate it through the future, what you see is that by about November 2014, you reach the 6.5% threshold. However, and assuming that that is the rate of decline, that the rate of decline we've seen since end 2009 continues, assuming that rate of decline continues, assuming that we cut 6.5% in November 2014, the question is, will the Fed immediately start raising interest rates or stop its asset buying program? I think probably not. They've stated time and time again that they want to be absolutely sure that the economy is on a recovery path, that the improvement in unemployment is for real, and they will be very slow, I think, therefore, to tighten monetary policy even when 6.5% is reached. So yes, I think when are we likely to see a shift in policy? If it happens, probably the first half of 2015, which suggests that those who started to get concerned about a shift in Fed policy this year really, I think, far too premature in their concerns.
Recently, and you talked a little bit about this today, some people interpreted the Fed minutes for the December meeting to be somewhat bearish for precious metals because suddenly they thought that QE would be coming to a dramatic end sometimes in 2013. And if I'm not mistaken, you were pretty adamant that that wasn't going to happen.
No, I don't think so. I think, in fact, there's been a misreading by some of the FOMC minutes. If you read those minutes, what you see is that the Fed is essentially looking at different scenarios, different outcomes, what would it do if? But they very clearly stated on the record that policy will only be tightened if and when they are very comfortable about the state of the economy and where unemployment sits at that time. And I think that, given the track record that we've seen to date, tells me that there is very little chance whatsoever that this year we're going to see any meaningful shift in Fed policy, quite the opposite. And I'm pretty convinced of that as well because of what I expect for the US economy. If you look at the US economy this year, yes, things are starting to get better, but the rate of improvement is relatively gentle. And that's not going to be enough to bring about big drops in unemployment in a hurry.
So the world's central banks are buying gold for insurance. It looks like the Fed is put in a box and probably won't be able to raise rates till sometime in 2015. We haven't even seen the money multiplier kick in here in the United States as the Fed has continuously pushed more money as far as money supply is concerned. And if that starts to kick in, all sorts of things could start to happen. But we talked a little bit today about your projections as far as price range in gold. And could you please share that with some of our listeners today?
Yeah, I think that this year we're probably going to see a low in the 1640s. I think gold is pretty well defended, just a bit below its 200-day moving average, which I think is currently 1663. I think we could drop a bit below that in the short term. That wouldn't surprise me. But I think the trend this year will tend to be higher, even if we will have periodic declines in the gold price or moments of weakness. And I think we're going to get through 1920. I think we'll take out the September 2011 high. And I think there's a reasonable chance that we'll have a sort of one touch of 2000.
Interesting. Now, obviously, today we traded as low as, I think, 1664 was today's low. So based on your projections, 1640 being the lower end of the range, we're within 1% of what you believe could be the lower end of the range. So if you were a potential buyer of gold and you haven't pulled the trigger yet, today's price level is probably something that you might want to take advantage of.
I would have to conclude with that. Yes, I think that's very true. I think we are currently trading, if my forecast is correct, very much near the bottom of that range, the trading range.
Now, you also talked a little bit about silver, maybe being a little bit more volatile in 2013 and maybe outperforming as far as gold is concerned. What are your views there?
Well, I think silver is very likely to outperform gold on the upside. That's the traditional relationship between gold and silver, is that when gold makes a move, the gold-silver ratio tends to narrow in silver's favor. We're currently trading at about 52 to 1, silver against gold. I think that we would see silver move towards 45 under circumstances of much stronger gold prices. And if that's the case, and if I'm correct about where gold might go this year, then that's telling me that silver's got to get into the low 40s. Compare that to current price levels, and you're looking at a 30% potential price increase at some point this year. That is probably somewhat better than we're going to see in the case of gold.
Silver last year tracked below $30 an ounce a couple of times, but it seemed to be very well bid every time
Yes.
it went below there. Based on that, what are your ranges for silver for 2013?
I think silver could just fall temporarily below $30 an ounce. I think you could see 28, 29 at the worst. And then I think if we look at the upside, we're looking at something like $43 an ounce this year.
30% move, a tremendous move as far as any investor is concerned. Now, the other white metals, the PGMs, they seem to be getting a lot of action recently. There's been some announcements out of South Africa. There's been news that car demand is going to continue to increase for the next 3 to 5 years. So the price of platinum and palladium has been very volatile. We've seen platinum trade off the lows of 1550. Recently, we've tested 1700. Palladium was down as low as 585. Recently, we've tested that 725 resistance level. Could you share with us real quick what your range expectations are for the PGMs, platinum and palladium?
I think in the short term, platinum is a bit overbought. I think if we look, for example, I think at ETF holdings, we're at record levels. There's also been tremendous amount of money coming into the platinum space, basis the announcement made by Anglo Platinum that they're going to shut down marginal production. I think the problem is that we might find out that cutbacks in South Africa happen a lot more slowly and have a big question mark against them because of government pressure against these mining companies. There's a lot of jobs which will be lost if these closures take place, and it may well be that the closures will be slow-tracked in response to government pressure, and that will disappoint the market somewhat. I also think that people need to take into account the situation in Europe when we look at the platinum market. Europe is the sort of heartland of platinum auto catalyst demand, because Europe is where most diesel vehicles are sold, light vehicles are sold, and the European car market is in a really bad way. We're looking at projections probably for marginal declines in car sales again in Europe this year. And if that's the case, the demand side for platinum looks a bit weak basically. Couple that with continued production and not the cutbacks that are being talked about being implemented quickly, and platinum may in the short term disappoint. Now, having said that, if gold goes up, how big would the discount be on platinum against gold? That discount will be arbitraged away as well by those seeing platinum as good value relative to gold.
So, how about palladium?
Palladium, we are somewhat more friendly to, and we're more friendly towards palladium because if you look at palladium, this is the only one of the 4 precious metals that's in a fundamental deficit. And what I mean by that is if you look at palladium recycling and palladium mine production and compare that to manufacturing or fabrication demand for palladium, the market's in a fairly substantial deficit, not enough supply. That is a very strong underpinning for the market. And if you couple that with the possibility of investor interest and a lack of Russian selling and pretty good demand growth from auto catalysts for petroleum powered vehicles in emerging markets in the US where the car market's getting better again, you're looking at a pretty positive situation for palladium. And I think therefore prices for palladium could rise quite substantially still.
Now, when you say quite substantially, obviously what you're sharing with us today is that palladium is one of the few precious metals that's in a supply deficit. And recently we've seen the price as low as 600. Where do you see the upper end of the range as far as palladium is concerned?
I think palladium will probably make a run towards the $900 mark. I don't think it'll get there. There are quite substantial stocks of palladium being for the time being, quite tightly held, and I think they're quite concentrated stocks, maybe held by hedge funds, and I think these stocks will come into play at higher prices. The question, of course, is at what prices will we likely see liquidation out of some of these stocks. So I think we need quite a lot more than $700 to see that happen. So I think there's room for palladium prices to move, as I said, towards $900, perhaps get above $850, and then I think you'll see quite a lot of selling pressure come into the market.
Fantastic. I'd like to thank Philip Klapwijk for sharing this incredible information with us today. And obviously, this is going to be an exciting year for precious metals. So if you're interested in using precious metals to help protect your portfolio and potentially profit, please give us a call at Monex today. Thank you.